What dating advice do you have for someone who is no longer in the social class they were born into? I'm not going to read her entire question just for brevity's sake, but the idea is that this is somebody who grew up in a lower class but has managed to advance to doing well academically. And she's socially relates more to people in her the class that she's probably going to end up in when she finishes her education, but didn't grow up in that background. So there might be some possible disconnects. And so the question she has is she doesn't completely socially fit in with upper class yet in terms of things such as dress and travel and her spending ability, but can relate to them more on an intellectual level. The answer really is when it comes to the social class and dating, I'm actually going to be doing a video about what kind of class you should date. And for people who are younger and in their education, you shouldn't use the class you were born in as your basis, but the one that you will likely enter upon your first job out of school, because that's probably a more accurate metric. The one thing that does scare off a lot of men maybe, or just people in general, when it comes to dating somebody who's moved up through education is, well, they have to support the in-laws' retirement. And if you make that clear that that's not going to be an issue, or if it is going to be an issue, if you find somebody who's okay with that, then I don't see why it can't work. I think you can easily date somebody in whatever the new class that you're going to be moving up into because of your education. And a lot of the things that you are concerned about just can be learned over time through socialization. And once you do have your new career, you'll have the income to be able to catch up. So I think commenter who asked that, you'll be fine. You'll be able to, I don't think you're going to have a problem finding a true love partnership because you are moving into the class of the people you want to be with. Then the next question I have is there's a three-parter. What are your thoughts on what's going on with the Department of Government Efficiency? Generally, I think they are surprising me and doing a better job than expected, like with this whole exposure of U.S. aid and finding a lot of other wasted spending elsewhere. I mean, my estimates is that they can, the DOGE, based on the video I did a week ago about balancing the budget, they'll be able to find about $325 billion in misallocated capital. If they get over that, then the deficit can get down a lot lower than even people expect. But I wouldn't really count on that necessarily. So yeah, so far I think they're doing a good job. The next part is, what is the financial and economic implications of a power shift of techno-feudalism with Elon taking over the government? I don't really think Elon is taking over the government. He is just using modern technology to figure out how to cut some of the advantages the political class has built into the system themselves. I think it's a technological development more than Elon being some power broker, because with AI and a lot of the other advancements in digital technology, you can find the rats in the ship a lot easier. And that's exactly what he seems to be doing. You can't get away with a more transparent world. You're not going to be able to hide some little kickback. Question I have is, can you walk through the implementation deals of a land value tax at a state or federal level? I think it'd be the same steps as implementing a property tax. I think with a federal level, you would need to have to go through Congress and the Senate. There's nothing in the Constitution that prohibits property taxes. So, and it doesn't state, the 10th Amendment doesn't state that anything that's in the federal government is in the state. So you might need a constitutional amendment for a federal property tax or land value tax. But on the state level, you can just pass it like any other kind of tax. But that's kind of the answer to that question. Next one is BRICs. I've been getting a lot of questions from you guys about BRICs. What are my thoughts on BRICs? Well, when it comes to BRICs, I think they're not as big of a threat as the commenters on YouTube seem to be concerned about, just on my channel and generally otherwise. The main real issue that BRICs could have is creating a rival currency to the US dollar. And if they succeed at creating a rival currency, US dollar, then people will not trade in dollars anymore. And then you've got a major problem. But I don't think that is going to happen. Oh yeah, boots were made for walking. I already answered your question earlier in the video, so you can go rewind back if you want to hear the answer. But I don't think you have as much to worry about when it comes to dating a new social class. But back to the point of BRICs. So when it comes to BRICs, the only way they could create a competing currency is by backing up something harder than the US dollar. And the one thing that is consistently harder than the US dollar is gold. And you see gold prices have rallied a lot, and that is mainly due to central bank buying. But it's not just BRICS central bank buying, it's central bank buying across the globe. And they might be as a way to protect themselves from SWIFT bans or what happened to Russia and being cut out of the capital markets and having something to stabilize your currency. So yeah, if the BRICS countries, particularly China, can buy a bunch of gold, then by doing that, you can theoretically create a hard gold-backed currency, and a hard gold-backed currency is more valuable and more trustworthy than a fiat currency, even if it's a fiat kind of currency from a country with the world's strongest military. So that would be the game plan. China would probably need to at least increase their gold reserves by about 5x from where they are right now. When it comes to the BRICS currency, is that they can't, unless if they can have enough gold to back it, nobody's going to switch. And you might be able to use another hard asset like property or real estate or silver or some other commodity that's not perishable. So our last question here is, how realistic is this plan? The Secretary of Treasury, Scott Bessent, and President Trump aim to reduce the 10-year yield to lower borrowing costs for consumers, business, and government. The strategy focuses on promoting energy production, deregulation, and achieving non-inflationary economic growth. Bessent wants to use the approach of a 3-3-3 plan, which is targeting 3% real GDP growth, reducing the deficit to 3% of GDP, and increasing U.S. oil production by 3 million barrels per day, which is currently at 6%. So, which is the deficit. So is this realistic? Can you get 3% GDP growth, increase oil production by 3 million barrels per day, and reduce the deficit to 3% of GDP? So let's go into 3 points when it comes to this. First, the 3% real GDP. Yeah, that can be done with enough pro-growth policy. The risk really of getting real growth that high is that it comes with inflation, which would impact the deficit goals. The second one, reducing the deficit to 3%. So currently it's at 6%. I don't know if you guys watched my video about balancing the budget, but if you followed all the spending cut guidelines in it, that would get us down to a little under 3% without any tax hikes. So if you had a very aggressive approach to spending cuts and the DOGE was able to extract at least $350 billion in spending cuts just on efficiency, then you can do it. The problem is that there's a lot of special interests that are going to try to prevent that. And that you also would need to do is not have any tax cuts or pro-growth policy. So you would have to cut that amount plus any additional amount to compensate for pro-growth policies. So this is probably the first two goals kind of contradict each other to a certain degree. And the third one is oil production to 3 million barrels a day. That's doable if you deregulate ANWR in Alaska for drilling, and you kind of nudge the oil companies to start focusing more on output by making the export market more attractive, or some other incentives, because right now the oil companies are more focused on profit maximization than on growing production, because they've been burned in previous cycles and don't really want to make that mistake again. And so as a result, you need to have some sort of additional incentive so they don't overproduce and then oil crashes and all the capex goes to waste. So I think that one is realistic. The oil one is, and I think the deficit or the 3% real GDP, it might have to be a either or. But the other side of it would be I think though, if you could actually get some growth to compensate for the deficit going down, but if you cut the deficit by 3% GDP, that means you really need to grow the private sector by 6% to get to the Bessent's 3% target. I mean, I'd be happy if we can have a positive GDP growth number despite cutting the deficit by 3%. If you could have that, that's a win. And I think everybody would be satisfied with making our government a little bit more solvent and without causing a recession. That should be the goal. I don't know if 3-3-3 can be done, but like I would be happy with 1-3-3. So that's kind of my answer to the question. And I think I like some of Bessent's more innovative approaches to kind of handling this. And the biggest mistake that the Biden administration failed to do is Yellen, the Secretary of Treasury, did not, and I'm talking just solely from a fiscal monetary perspective and from the Secretary of Treasury's power, not some of the other things the Biden administration did, is that she didn't issue long-term bonds when rates were next to nothing during 2021. Like we had a point, or also even Mnuchin probably should have done this back during the end of Trump's presidency too. We had a point where the 10-year was at 1% and the 30-year was under 3%. And you should have just been, if you really wanted to balance the fiscal situation and be able to fight inflation without worrying about a debt crisis, you should have just issued only long dated bonds. But the government prioritized more just keeping interest expenses down in the moment. And so it got short loaded. And so as a result, a lot of the average maturity duration for the treasury market's under 7 years when it really should be much longer. And it's unlikely we're going to get down to those rates again. And so that's kind of a unfortunate, really, mistake